Hello and welcome to this week's Australian Stock Market Report. Now this week we're going to look at Life360, which is up 300%. Will it continue to rise? Then we'll get into the Australian stock market so I can share with you my thoughts, where it's heading, along with answering all of your questions and looking at stocks for you. Hello, I'm Dale Gillham, the Chief Analyst here at Wealth Within, and we're Australia's most trusted stock market educators. Now before we move on, thank you for showing your support for our channel and hitting that subscribe button. And remember, as you subscribe, click on the bell on the right of it so you keep up to date with our latest videos. Also remember to tune into our live Australian stock market show, which is on each and every Tuesday, 7 to 8 p.m. Australian Eastern Time. Now this is the show where you get to ask us, the stock market education and trading experts, to look at your favourite stocks and answer all of your questions. Now, I was recently introduced to an app called Life360, which is designed for family and friends to share their location. Now, one of the cool features of this app is it allows family members to track how fast people are driving and call for assistance if someone is in an accident. Now, whilst the app is free, it also has some additional features which subscribers pay for. Now, when I investigated this company, I found it was headquartered in San Francisco, but it had listed on the Australian Securities Exchange in May 2019. Now, during the IPO, it raised $112.7 million by issuing 23.5 million new CHESS depository interest, or CDIs, at $4.79 each, as CDIs allow a non-Australian company to list on our exchange. Now, the company began trading on the 10th of May 2019, but like most IPOs, it traded down in price, and by the 23rd of March 2020, it had fallen over 70% in price to $1.51. Over the last 12 months, however, Life360 has achieved a 20% revenue growth year on year, despite COVID-19, which has seen its share price rise over 300% to a new all-time high last week of $6.49, with many analysts promoting the stock as a strong buy. Now, whilst I like the look of this stock and I believe it has potential to rise further, I think most of the rise has already occurred at this point in time, and at least for that in the short term. That said, over the longer term, this stock looks attractive as it is in the technology sector and has a broad international client base paying monthly fees, so subscribers can have peace of mind not only knowing where their loved ones are, but that they are safe, which means they're likely to be very loyal long-term users of the app. Now it's time we look at the market, and first up, what is the best and worst performing sectors from last week? Well, the best performing sector was information technology, and that was up 6.96% after Altium rose over 28% on news it rejected a $5 billion takeover bid from US technology company Autodesk, with Altium stating that the offer price of $38.50 undervalued the company. There were also merger rumours about Iris, which resulted in it rising over 20% last week. Now, utilities was the next performing sector, and that was up 2.89%, followed by healthcare, up 1.92%. The worst performing sectors included financials down 1.92%, consumer staples down 1.01%, and consumer discretionary, that was down 0.78% for the week. The best performers in the ASX S&P Top 100 stocks included Altium, up 28.63%, followed by Appen, that was up 13.15%, and Afterpay, that was up 9.57%. The worst performing stocks included the Star Entertainment Group, and that was down 4.53%, followed by Bendigo, Adelaide Bank down 4.13%, and Worley, that was down 4.08%. So what do I expect in the market moving forward? Well, let's get into the charts for our S&P 500 All Ordinaries Index update for this week. We'll also answer your questions and look at the stocks that you've chosen for me.
A quick reminder before the video starts. This report is an educational tool, and as such, your personal circumstances have not been considered. We hope you enjoy this week's report.
All right, during the week, our market did make a new all-time high, but is it really looking strong, and how far can it actually go? So that's where the charts will tell us. But first up, I'm going to bring up a monthly chart. So on your screen, if you want to have a look there, we do have the monthly chart on the All Ordinaries Index, which is the same chart I've been using for months and months. And if you take it back, you can see there that long-term sort of momentum line that we've got here. And you can see here, currently the market is trading well above that sort of long-term momentum, and it does really need to come back and slow down. down a little bit. It doesn't stay above it for too long, and we are now getting into this sort of long period of time here since that March 2020 low. So we're way past that, about 15 or 16 months now. So it does look like we are going quite vertical at the moment. You can see the speed of this. We did slow down a little bit through here. We slowed down a little bit through here, but now we're going very fast again, and we've had 1, 2, 3 months up through here, and currently we're 1, 2, we're in our third month up through here. So I would expect it to slow down because, as I said, it really shouldn't be staying up at these sorts of movements for too long. We had the big move right through up to the GFC there, that big long move from our longest bull market, but it was much more sustainable. If you put my little trend line on here, you can see here that the move here is quite steep. And if I drag that over there, you can see how different it is. The major difference here is this current move is so steep compared to what it was in this beautiful, which means the fundamentals are way out of whack at this point in time. And talking about the fundamentals in our market, it really is suggesting our market is a bit too high. It is a little bit overheated, and we are due for a bit of a pullback. So I am expecting a bit of a pullback. I'm not expecting a crash, just 8 to 12% pullback, and it could happen anytime soon. But let's go on to the weekly chart and see that. And here's your weekly chart, and you can see we had the 2 strong weeks through here, which was really nice to see. It did power up, but last week it wasn't super strong. It was a bit of a smaller week through there, even though it did close high there. And if I go down to the daily, you'll see last week's bars. It was quite flat. You can see there's Friday pretty much opened, well, it opened at 7,558, closed at 7,577. So not a lot of movement there on Friday, but pretty much a sideways movement pretty much for the whole week. Not really rising. So it is possible we will start to turn down this week. If we start to turn down this week, we may feel that it could be just a bit of a retracement and then go back up again, or if it breaks below that low there, which is 7154, then I would suggest it's starting to tell us that the downward move will be starting right now. We will go down for the next 4 to 6 weeks. So it'll all hinge on this week. If we do get a strong bar through here, that the strong rise is going to keep going. Now, remember, I've been telling you 7,600 points was my target level. It's nearly at that. We can make 7,800 points, but I think 7,600 will probably pull it up. And we'll start to fall away there. But again, time will tell. The market will do what it wants to do, not what I think it might do. And right now the market is funny, and it has been funny all the way since this March 2020 low. It has been really a strange type of market where it spent sort of pretty much 2/3 of its time going sideways rather than 2/3 of its time going up. But I want to show you a couple of other things on the market before we finish up today. I want to go into the sectors and just show you a little bit about the sectors. This is just our spaghetti graph of the sectors that Janine and I do, showing you what's going on. And you can see here these sectors here. So you're looking at these are the ones all turning up, like energy the other week has turned up really well. Information technology has turned up really well after being more bearish, and utilities there. But let's get into here and have a look at this. This is what happened with the sectors last week, which I mentioned a little bit earlier in my report. But let's go into the month and see what's going on in the month. Now, energy's been the best performer this month, up 9.58, followed by utilities 9.18, and information technology 6.78, with consumer discretionary, financials and communication services all being the worst performer. Now, we're roughly halfway through the month, but energy hasn't done as well this year. We took off in January like I thought it would be, quite good energy, but then from February onwards it hasn't done well till this month. So let's now go to the year and really do look at the sectors, because this is where you look at sector rotation and obviously where your portfolio may be going and what stocks, because what stocks run for 3 to 6 months or 12 months will generally slow down then, and then the stocks that weren't running very hard will start to move up again. And you can see financials up 20%, communication services up 14%, and consumer discretionary up 13.89 for the year. Whereas information technology, which may surprise some people, is the worst performing sector, down 6.59. Even though we've had strong rises from Appen and Altium and Afterpay this last week, information technology is the worst performing one. Utilities down 2.26. Consumer staples also down that in the bottom end, where the All Ordinaries Index is up 10.61%. So where the moves have all been this year has been materials, consumer discretionary, consumer services and financial. So this is where your money needed to be. But we think healthcare should be doing okay moving forward in the second half of the year. Energy should also do quite well in the second half here, and consumer staples I think should do okay as well. from there. But information technology, the jury's still out. I do like some of the stocks and some of the moves here at the moment on these information technology stocks, some of those WAC stocks. We haven't got confirmation that they've stopped falling, even though they've had some strong rises over the last couple of weeks. It really doesn't mean that they are actually moving up, and you do need to be really, really careful of that. I've just got the Australian technology stocks, those WAC stocks there. So we've seen Altium this year is only up 2.1%, where Appen's down still this year, down 44.51%, with Afterpay still down 13.5 and Xero down 9.94%. But if we go to the week, and you can see the difference there, Altium up 28%. So there's 28% rise, and it's still down. Appen up 13.15, Afterpay up 9.57, which I mentioned in my report a little bit earlier with WiseTech and Xero. So I'm not saying that these stocks aren't now moving up into uptrends or nice uptrends where you're going to make some money. I'm just saying it's really a little bit early in the move. So don't get FOMO at this point in time. That's really what I'm saying, is because if you have FOMO, you could be buying them on this bit of a reaction. If I just bring up this stock here, what you might be seeing is a bit of a reaction if there's a downtrend there. No, a move up in the opposite direction before it starts to fall away. And I'll draw it with my trend arrow actually. Sometimes you'll see this generally in a downward move. This is sort of the move will actually happen. So we could be seeing these sorts of moves at the moment on some of those tech stocks where they're just moving in the opposite direction to the trend. People buying in on FOMO before they turn over. And I'm not saying that's going to happen. I'm just saying you're running the risk at this point in time until we can confirm that it is the bottom. What would confirm that was the bottom? What would confirm that was the bottom? And that's what we need to do at the moment. So don't jump in too early. But if you've got good insights into these stocks and you've done some really good research and analysis on them, you think, hey, they're good for the medium to longer term, then by all means have a look at whether you put them into your portfolio. But you really do need to ensure that you're looking after yourself. Just don't buy because other people have bought in the last week and something's up strongly, up 9, 10, 15 or even 28% like we saw there for some of those stocks here this week. So just be careful. Don't just jump on things thinking they're running, because the market is due to pull back and you don't want to be buying just before it starts to tip over. So that's my take on the market for this week, and we need to get into the questions that you've asked me. Now, the first question we have today is from Peter, who says, hi, Dale and Janine, I held Link Energy shares that are no longer around. Now, he says, I lost my investment in them, so I was wondering how long in the future, if at all, can I write that off against capital gains tax into the future? Now, right now, I earn under the limit for taxable income. I'm just querying for the future. Thank you. Really, really good question. And honestly, I can't give you an exact answer on that. I'm not an accountant. So I can't remember what the deal is in terms of how long you can have a tax loss from selling something like that or having that offset off capital gains. That's why I have accountants. They remember those sorts of things for me. But I would say go to the tax office, the ATO, so ato.gov.au, and have a look there, and they probably would be providing the answer, or they will provide the answer there. Or if not, just give your accountant a bit of a call. But I'd probably think if you're not, it's about if you're looking at right now, you're under the tax threshold for paying tax, so buying and selling at this point in time, obviously you're not being taxed on that. Is that a short-term situation where you're going to be you're under that limit, or is it something that's likely to go under for 5 or 10 or 15 years? Because that will depend on how important the question is. I do know some retirement people that are just on that borderline or just below it, and it's going to be a non-issue for them ever. So I'm not sure what your situation is, but as I said, the best place to go is to your accountant and just ask him the question. And the ATO, which is ato.gov.au, they will have the answer there for you if you can get through all their pages of stuff. A great place. I'm always visiting that website, having a look at certain things just to know what I can do and make sure I'm doing things legally as well. But great question, and thank you for watching the show. Now we have a question from Demos Viking, who says, Dale, I'm also worried about the market collapsing right after I buy, but it keeps going up every day non-stop and I'm getting massive FOMO. What do you think is driving this endless pump? The P of most stocks are much higher than pre-COVID. End of the day, it's just about having a solid strategy and a plan. I think people that have FOMO, I'm not worried about the market. To me, it will pull back 8 to 12%, and if that's okay for you, then that's fine. It's really been understanding, and I know a lot of people that have like more buy and hold type portfolios. And if you understand that the market pulls back twice a year, which it generally does, like I've talked about it generally will pull back somewhere around 6 to 8% once and 8 to 12% once in a year. So twice in a year you'll have pullbacks, and if you're holding that whole year, you just know that that's going to happen, and when it does happen, you don't get worried about it. But it's also, if you do get worried about it, that's just telling you don't know enough, and it's not about being rude to anybody that's watching. It's just saying, if you understand the market, then you understand what it's actually doing and the psychology that's happening at any one time. Now, it is going up, but it's not going up super strongly. We had 2 weeks up, and then last week was a bit nothing, but it really hasn't traveled very far. It's only up 10% this year. Whilst you may be looking at individual stocks and going, oh, why can't I get into that? It's really about doing analysis, and I can't stress this enough. If you've got good technical analysis skills, you'll never ever have FOMO. It's just not something that I ever suffer from, because simply I understand how the market's moving and stocks are moving. So when you understand the technical analysis and you're understanding all the fundamental analysis about what is good value, what's stocks that you should be owning, but then combine that with the technical analysis of when to buy it, FOMO just disappears, because you know when you're buying before the peaks, or you know roughly when it's buying before the peaks. But even if you get it wrong, there's always another stock, because you can't be right 100% of the time. So for example, buying Afterpay, people thought that had stopped falling and they started buying that, or Appen or Altium, what we're talking about at the moment. Some people have seen those moving up and they're getting FOMO, but really it's about having, if you've got good solid trading strategies, trading plan, you're doing good analysis, then FOMO, as I said, it's just a bit of a non-issue. But really, just be patient. The best traders are the most patient people on the planet, because they wait for trades to happen, and they wait for low risk times that they have good low risk on their money, but good potential to make profits. It's about probability. That's all it is. So please, just I'm not telling you to sit on your hands. I'm just saying make sure you do your analysis properly. And if you're happy to buy into stocks, just buy into them, because they're not the market. So stocks will rise and fall in opposite directions to the market, depending on what the stock is and what they're particularly doing at any one time. So if you do find a stock that looks good and you think it's going to go up for medium to longer term or short term, whatever your trading strategy is, then I have no issues with you buying it right now, regardless of what the market's doing. But thank you for asking the question. Now, moving on, we have a question from Chris, who says, what is your view of share buybacks in which dividends belong to all shareholders are distributed to those who participate? In theory, the non-participating people are promised higher future share price and dividends, but this may not eventuate. Should buybacks with dividend component be legal, as they appear to be inequitable? CEOs have incentive to create higher share price in this way to achieve bonus benchmarks, but is this really a fair way to do it? I don't know what you're talking about in terms of the stock you're talking about with share buybacks and everything. I know whatever companies do, it must be equitable to all shareholders. It's mandatory that they are equitable to all shareholders. Share buybacks are generally a good thing. It's basically using excess cash to buybacks. Now, a lot of companies, they will buy back, like Westpac for years were just doing buybacks on the marketplace. So they were just buying shares off the market. So it wasn't affecting, they were just using excess cash. Now, sometimes if they want to do the buyback quickly, they will offer incentives to shareholders to sell those shares, like for example, using franking credits or something like that. Or maybe purchase at a slightly higher price than the market is trading at the moment. So let's say a stock is trading at $1, maybe offering $1.05 to buy the shares from some people, and some people will take that bid and then sell their shares to the company. So there's different ways of doing it, but hey, it really is about supporting good, strong money management, capital management of the company, so it will support that company. So I don't think it's a big issue from my point. As I said, but if I did have the details of the company, I might have been able to research a little bit more and get a bit more detail about what the offer was to work out whether I thought it was fair or not. But companies do have an obligation to be fair and equitable to all shareholders. After all, if you're a shareholder, you own the company, so you'd want it to be fair for you anyway. But thank you for asking the question. It's a really interesting one that you would bring up. But share buybacks are going to support the share price, as you put there, and it should increase that share price moving over the more medium to longer term. So great question anyway. But thank you for those who did send in a the question. I really do appreciate it, and I really hope I was able to assist you today. Now, if you are sitting there and you've got a question yourself, then the first thing you need to do is subscribe to the channel and then stick your question below in the comments section, and I'll endeavour to answer it in next week's recording. If you don't ask it, it's never going to get answered, so please make sure you get your fingers on the keyboard and start asking the questions. Also, give us a thumbs up for the video. Now, remember, here on this channel, we do these Monday market reports each and every week. We also do our live stream every Tuesday night, 7 to 8 p.m. Australian Eastern Time. So hit the subscribe button now, click the bell on the right of it so you know when we upload videos and go live with our show. I'm Gillham, the Chief Analyst here at Wealth. Goodbye, good luck, and good trading.